Now, what you're going to see here is a bunch of red numbers. You guys who have iPhones know this. Those red numbers are robo-dials. If you're self-employed or if you work off your cell phone all day, every day, it does become quite a nuisance when people are calling in an unsolicited fashion. But not following the do not call list is, to me, an ethical violation, and actually it's a legal violation as well. And given that we are all licensed, it's something that I take close to the heart because I really don't want to talk to people who don't want to talk to me. Let's start off with the top 4 questions I was asked this week by those looking to buy houses this spring here in Denver, Colorado. So the first question that comes up a lot when people are looking to buy their first home is closing costs. And this one was interesting because the client asked specifically, what are the different closing costs for the different loan programs? So first, let's stop and let's kind of get a little background there. Loan programs. So if we're talking about conventional and FHA. So let me break apart the subtle differences. Okay, so VA could have a funding fee. If you have 10% disability, that funding fee will be waived, but that is unique to VA. It does not apply to FHA or conventional loans. What does it do? It allows us veterans to finance our homes at 100% financing and have no monthly mortgage insurance in our payment, and also achieve lower interest rates because VA loans are, in fact, backed by the Department of Veteran Affairs. So that is the one unique cost for a VA loan. FHA has what's called upfront mortgage insurance premium. It's 1.75%. So if your down payment were 3.5, they are going to finance back 1.75%. But just like in the VA loan, the FHA loan, they allow you to finance this if it is applicable to you. Conventional loans do not have these upfront costs. Again, FHA does it because it also allows to help keep down payments lower while maintaining competitive interest rates. The FHA loan, different than VA, has a monthly mortgage insurance in addition to that upfront mortgage insurance premium. Conventional loans, what would be the difference there between those two? It might be if you have mortgage insurance, whether it's you pay a one-time so you don't have it in your monthly payment, known as upfront mortgage insurance, or you have monthly or private mortgage insurance. Those would be the costs. But let's break down closing costs, just generally speaking. You're going to have your lender fees, you're going to have title fees, and this is referring to Colorado being a title state. And then you're going to have your prepaids. Prepaids would be that interest to the end of the month, which you close in. Then you're going to have 1 year of insurance paid by the title company upfront to your insurance carrier, because insurance bills once a year. And yes, then it goes into your escrow account. So then there's the escrow setup, a handful of months of taxes and insurance after closing. Okay, so those would be the prepaid items. The title fees, there is one on the Colorado contract that's determined to be paid by the buyer or seller, depending on he or she who picks the title. Check with your agent about that. It's called owner's title policy. So that would either be paid by you as a buyer or you as a seller. Depending on the Colorado real estate contract, that fee will belong to that party. So that's an important fee to look out for. It could be hundreds of dollars to you as the buyer or the seller. Appraisals, they're about $675 right now. But look, if you're up in Summit County or you have a beautiful home that's going to be, say, north of $1 million, those appraisal fees can be higher based on distance, based on size, uniqueness, etc. So ask the lender. Typically, it's going to be paid up front and then credited to you by the lender at closing. So you're not paying for it twice. You're paying for it up front when the appraisal is ordered there. So those are kind of the subtleties of the closing costs. There's not specific closing costs outside of that. The underwriting fee will be the underwriting fee. The credit report fee will be the credit report fee, etc. Next one is related to seller concessions. And the question was, what's trending right now and what's the best way to use those as a buyer if I were to get those seller concessions? It depends on the amount. And let's go back to these loan programs real quick, because with a VA loan, you can get up to 4% concessions. With a conventional loan, it does depend on your down payment, but let's say you do a 5% down payment, you can get 3% concessions. And then if you put down more than 10%, you can get 6% concessions on the house there. So check with the lender on this. And then with FHA, you can get up to 6% concessions. Now, I doubt you'll get a seller to give you 6% concessions. How can the money be used? The money can be used to pay your closing costs. The money can be used to pay those prepaids. that first year of insurance, as people lump this all together, usually in closing costs. The money can also be used to buy down your interest rate. So what is a buy down? And that's kind of what the question led to, which is buy downs. What are they? How do they work? And which one's better? Well, let's talk about what a buy down is first. The interest rate you get without paying any points is known to us lender as the par rate. From there, if you pay a point, typically 1% of your loan amount, it will buy down the rate permanently. There's not an exact amount. Is it 1/4%? Is it 3/8 of 1%? It really depends on the financial markets at the time that the rate is locked. And that's the ambiguity about rate buy downs. Because if you walk into a brick and mortar bank, they may say, if you pay 1% discount fee, your rate will go down 1/4 of 1%. Well, that's not how the financial markets work. And when you're talking to mortgage bankers, mortgage brokers, it's typically not the case either. But talk to your lender so they can educate you about this so you can decide if it makes sense. I personally look at buy down money as dollars and cents. If I paid X dollars to buy down my rate Y and I save Z dollars per month, how many months before that was a wise investment? That's kind of how I would look at a buy down, because to me, numbers are just logic. And if I were to refinance or think I'm going to refinance in the next few years, is the break even going to happen? Was it a sound investment? Or could I have used that and had it come off the top of the price of the home? So that's another idea for you as well. So that's a permanent buy down. Then you have what's called a temporary buy down. A temporary buy down is where, if let's say hypothetically your note rate were 6.5%, most common temporary buy down is a 2-1 buy down. So for the first 12 months, your payment is based off of a note rate of 4.5%, then 5.5, and then it lands at that note rate of 6.5% if you have not refinanced. Those seller concessions will be parked into an account, so buy down subsidy account, and then every month your mortgage payment is effectively subsidized because the money slid over to cover the differential that you're not paying since you have the temporarily lower payment off the buy down. One cool feature about that temporary buy down, it can help you grow into the payment, because for those first 12 months, you might see a noticeably lower payment than you would, say, 24 months down the road. And if a refinance were to occur, the money left over in the buy down account will apply towards a principal reduction of your loan amount. So if you get X dollars in seller concessions, make sure your lender and you get educated about what's the best and most applicable way to apply those concessions, because you can also ignore the concessions and take the price off the top of the house, which right now we do have one client where they're thinking they'll pay the closing costs and they would rather have the house be cheaper. Okay, so that's the gist of seller concessions and buy downs. Let's transition into something that is happening in real time in my life. Okay, so what I'm going to share with you is whether you apply for a mortgage when your credit is pulled, or you were selling a house, but maybe your property didn't sell for what you wanted it to, so you pull it off the market. Now, what you're going to see here is a bunch of red numbers. You guys who have iPhones know this. Those red numbers are robo-dials. The moment we took a property off the market, the phone started blowing up at 7 a.m. And so what will happen is real estate agents will pull information. They'll either call, or they might have a virtual assistant call to see if you want to relist your home. The irony behind this, I find, as a lender who only calls people that call us, is that there's a do not call list. 1-888-85 opt out. That is optoutprescreen.com. You can protect yourself from solicitations. A real estate agent friend of mine said, Ray, they don't scrub those lists when they're making these calls. So keep that in mind, because like me, if you're self-employed or if you work off your cell phone all day, every day, my wife's phone has been blowing up as well. It does become quite a nuisance when people are calling in an unsolicited fashion, and they're just doing their job to try to find more business. And so I commend them for that. But not following the do not call list is, to me, an ethical violation. And actually, it's a legal violation as well. And given that we are all licensed, it's something that I take close to the heart, because I really don't want to talk to people who don't want to talk to me. So if you're applying for a mortgage and I call you and you're like, listen, Ray, I'm going to go in another direction, or I'm just not going to do anything, that's great. I wish you nothing but success. So Keep that in mind. If you have a house and you pull it off the market, you're going to get blown up even if you're on the do not call registry. So be prepared. So you do have safeguards, of course. So you have a Google number, et cetera, et cetera. You can prevent all of this. This is just purely for educational purposes. Everyone's situation's slightly different. You know, I have videos on my website about things like closing costs and the market and other things related to Denver real estate. If you're moving here from LA or some other areas like Texas, there's some great videos on the website. Make sure to check those out. Subscribe if you like this kind of educational content, and you can always schedule a consultation, a one-on-one, calendly.com/mortgage maestro. Next up, I will likely be talking about deeper conversations about projections on interest rates. If you have a specific question you want to talk about relating to thinking about buying, I'd like to answer those for everybody just so y'all can get educated without pressure. Post it for me, shoot me a DM. We'll catch up with you soon.